Welcome to another real estate industry update. Today we're doing part 3 of our real estate professional status series. I'm Daniel Roccanti here with Kyle Paxton.
Daniel, I don't know about you, but I'm getting comfortable doing these now, so maybe we need a new profession, CPAs.
Well, there's gonna be a lot more after this, Kyle. This is just one series of many.
Party on.
So today we're going to talk about passive activity losses. Okay. So what is a passive activity loss? It's basically any trade or business that you do not materially participate is considered a passive activity. And there are certain rules that the IRS has implemented so that you cannot deduct this passive activity against non-passive activity. All right. So this is just when it was back to the Wild Wild West, people could take all this passive activity losses against all their sources of income. The IRS eventually stopped that about 30 years ago, and now we're stuck with these rules, okay? If a passive activity is allowed or disallowed, it's called suspended, and it's carried forward indefinitely. So you don't lose it, but it just carries forward until you can take it against other passive income in the future. So what is the difference between passive and what we call non-passive? All right. For the purposes of the passive activity loss rules, all income is divided in between non-passive and passive. Non-passive, okay, is basically anything that is wages, salary, trade or business income that you materially participate in. But it's also considered portfolio or investment income. So a lot of people don't know this, but interest, dividends, royalties, gains and losses on stocks, retirement income, even lottery winnings, things like this. These are not passive income. These are actually called non-passive for this rule, okay? And that's important to understand because passive losses cannot deduct against these sources of income, okay? So then what is a passive income? So passive income is any trade or business that a taxpayer does not materially participate. So if I have ownership in a business, but I do not materially participate in that business, any income I receive from that is passive income. Or rental activity. So that's what we're talking about today. All rental activity does not matter if you materially participate or not, is considered a passive loss here. Unless you meet real estate professional status, we'll get into. But for just the main purpose, all real rental activity, no matter what your participation level is at first considered passive activity. All right? This passive activity is recorded on Form 8582. All right? So if you want to get a little technical here, if you're looking at your tax return, this is where all those suspended losses are actually located and decided where to carry forward. And each activity shows you, so each activity has basically a passive activity loss associated with that activity. Okay, that's important to know about when you dispose of that activity. But we went over the general rules of passive activity losses. But if you meet real estate professional status, those go away. Kyle, take it over.
Take it away. Yeah. So this is the beauty of the real estate professional status, right? And we've talked in our other videos in this series, kind of giving an overview of what real estate professional status is and talking about the material participation requirements needed to meet real estate professional status and get these benefits. But the beauty of this is that real estate professional status pulls your rental property out of this passive world and into the non-passive world, which is oftentimes where we want to be for tax purposes, right? So this is really great where, a lot of times we're able to use various tax strategies around depreciation and other, generous sections of the tax code related to rental property to generate taxable losses that then can offset the other sources of non-passive income that Daniel, you touched on. And so, whether that's wages and salaries, things of that nature that normally rental properties by nature as passive activities wouldn't be able to offset. moving into this real estate professional status territory and meeting the material participation requirements pulls us out of passive activity loss rule territory into then non-passive treatment. And so we've touched on too in the other videos that if you're married filing jointly in your return status, it's one of the two individuals need to qualify as a real estate professional. And for purposes of the material participation test, you can use both taxpayer and spouse's activity to reach this. So there's a lot of good stuff there. And that as an accountant myself, I may not myself be a real estate professional, but if my significant other is, I can still potentially qualify for these benefits. So that's the biggest advantage here, is that this just pulls my rental losses that normally I wouldn't be able to deduct, or even if you mentioned earlier, I materially participate in my rental activity. If I don't meet the separate real estate professional requirements, I can offset now more up to $25,000 of non-passive income with these losses. But this totally frees us up to where there are no $0 passive activity loss limitation, no $25,000 limitation, and gives me a lot more wiggle room and space kind of for tax strategies around this. So that's the biggest benefit of this piece, is pulling us out of there. And we see a lot of, advantageous tax strategies around this. Ultimately, to get back to the point, this is all a timing difference, right? So we're playing with time value of money here. We're accelerating deductions potentially by moving into the real estate professional territory. So you mentioned passive activity losses carry forward indefinitely until they're disposed of. So, this isn't a situation where I'm creating more deduction in total per se. I'm just sliding it up, accelerating my cash flow in this year, so that I can use that for other investment opportunities and things of that nature. So with all of this, we're really just playing for the most part, we're just toying around with the time value of money here.
Yeah, and it's important that what Kyle mentioned here, the whole passive activity loss rules. Okay, we mentioned this in one of our other sections. It's not supposed to hurt real estate professionals. It's only here to hinder non-real estate professionals who are trying to use real estate as an investment to offset their other trade or business income that they materially participate. So the real estate professional status is actually here to help real estate professionals by saying, hey, I'm a real estate professional. All my money that I make, or most of it, is in real estate. Okay. So these losses is just part of my business. Okay. I'm not a doctor who makes a lot of money in my medical practice, but I'm investing in real estate because I heard I can take significant losses against my medical income. Okay. This is for real estate professionals. So if you're a real estate professional, you want to try and make sure your status, but the big rule is you have to materially participate. If you're not a real estate professional, it does not matter if you participate in your rental activity, it's passive. But if you're trying to get real estate professional status, you have to materially participate in your rental properties to get this status. And then it's just treated basically like non-passive income. All your income is non-passive, and that means you can offset it against all sources of income, and it's not being split between that non-passive and passive like before. So that's great when we're talking about losses. Okay? But is there any benefits to, say, I have passive and non-passive income?
Yeah, absolutely. So when you're looking at the income piece, there's a portion that people often don't know about or don't hear about, and that's around that investment income tax on passive income. So when you're looking at the net investment income tax piece, I feel like there's two forms people often are just blown away by in the tax returns, and that's passive activity losses and net investment income tax. So we get to dabble in both of those topics today. So net investment income tax is a 3.8% tax on top of your traditional tiered income, federal income tax brackets, plus any other state tax you're paying, and the 10 other buckets you can fall into to potentially be paying tax. So it's a sneaky 3.8%er that covers a handful of things. It sets in at certain income thresholds based on whether your filing status and all that good stuff. Generally what's included is your interest income, capital gains, dividends, investment income, and by default, rental income, right? So as one of those passive activities, you're picking up an additional 3.8% net investment income tax there. Now, real estate professional status, if you meet the material participation requirements above and beyond the real estate professional, that pulls rental income from the what counts in net investment income tax bucket into what doesn't count. 3.8% at high income thresholds adds up pretty quick, right? There's significant tax savings there. Just to kind of further my point here, your active trader business income and a handful of other buckets aren't included in net investment income tax. So this is on more of the investment type income, and your wages and salaries, business trader business income, social security benefits, things like that are included in that investment income tax. So that's another big advantage here, the real estate professional status.
And it's a big advantage. We mostly talk about losses when it comes to real estate, but there is another side, and that is sometimes rental activity makes them up as taxable income. Yeah, it's not bad, right? I mean, you want to make money at some point. That's why you're in real estate. It's not just to have losses, but a lot of times you confront the losses and then you'll have income in other years. When you have income, if you're in the higher tax bracket, you're going to be hit with this 3.8% net investment income tax. That's basically a 4% tax savings just by making less, even if you have income. So it's important to understand that this real estate professional status helps you on both sides, losses and income, and can help you in the current year by just saving 4% taxes right off the top. Okay. So let's go into what happens when I have carryovers. All right. So there's two ways to have it. I have a passive activity. All right. I can't use all my passive activity losses, so it carries over indefinitely into the future. If I'm a real estate professional, then all my rental activity is considered non-passive. Okay. And I don't have any carryovers, but it's a year-to-year decision. Okay. So that means in prior years, I could have been not a real estate professional and it would have been passive activities. And then this year I could be a real estate professional, and next year I could switch back to being a non-real estate professional. So by doing that, you could still have passive activity carryovers, even if you're a real estate professional. But if you're not, then you're definitely probably going to have it. Okay. So if I'm not allowed to take this activity, it just carries forward until I have passive income. Okay. If I don't eventually get rid of all of it, just say I never get to the point where I have enough passive income, okay, then I'm allowed to basically take it once the activity is disposed of, okay? And I'm allowed to completely unlock it, so not just against passive income, all right, but against non-passive income as well. So quick example, all right, I have a $100,000 loss. We'll make it a little bit, $100,000 passive activity loss carryover. All right. I have a gain of, let's say, $80,000 on my rental property I sold. Okay. So my $100,000 is now unlocked. So it wipes away my total gain. So I have no gain on the actual property because 180 of that wipes it away. But then I have an additional 20,000 that gets to be able to deduct against any source of income. Okay.
Exciting stuff.
It is exciting stuff. Okay. Now, we also talked a little bit about the grouping election in our prior videos. So just quickly go over that. You can group your rental real estate activity, all of it, into one activity. Okay. To meet the material participation rule. Once you do that, that activity, if you have 10 rental properties, is now all 10. Okay. So when you dispose of one, you're not really disposing of the activity, you have to dispose of all. Okay. It changes this rule. It doesn't let you unlock your prior year carryover, passive activity loss carryovers fully, but you can still take it against the gain from the sale. because it's still considered a passive activity. So, exact same example. The only difference is my $100,000 carryover, $80,000 gain from the sale. I can take the 80 against the 80. I have 20,000 left over that I can't take, unfortunately. Okay. And it just sits there still suspended into the future. Okay. So I don't lose it, but I still get it for future activities. But I don't get to unlock it against other sources of income because I technically did not dispose of the entire activity. Okay. So let's go over this is more like other roles. All right. We've talked about material participation. Kyle brought this up recently, but I'm going to stand on it. There's a thing with rental real estate called active participation. Yeah. If you're not a real estate professional, okay, and you actively participate in real estate, and active participation basically means I'm still making the high level decisions. Okay. Doesn't mean I'm property managing, doesn't mean anything like that. It just means I still make the highest decision. So like I own a rental property, the property management company has to come to me when there's something that needs to be expensed over $200. I still have to make the decisions on what the rent's going to be. Like I'm still making the very high level, like almost like a manager of it. Okay. If that happens, then you're considered active participation. And so if your rental activity falls under passive activity loss rules, there's a little bit of exclusion. So basically you can take up to $25,000 of losses with your rental real estate activity. Okay. And it can be offset against non-passive income. But once you make over $100,000, it starts significantly reducing. And once you make over $150,000, it's completely gone. So really, this rule is just for low income. Yeah, it's pretty tight. It's for low income people getting into rental properties. Yeah. The good thing, though, is if I say I have a normal job, I want to get into real estate, but I'm not ready to go full swing into it. I need money. I need my job so I can buy my properties. You might be under these thresholds. You might not need to make real estate professional status. Okay. And still get a pretty good benefit here. So this can help out basically people that are younger, wanting to get into real estate, but not meeting the real estate professional status. Because you can't meet it if you have a W-2 job. Okay, you got to have ownership in some kind of real property trade or business. All right. That's kind of active participation, but we'll go all the way back to all rental activity is passive activity. Well, there's exceptions, okay? Most rental activity is passive, but there's exceptions to these rules because the IRS considers this certain activity that we would consider still rental activity, actually not rental activity, okay? The one most people have heard of is the short-term rentals, okay? So this is basically any activity where the average period of customer use is 7 days or less. Okay? So that means if I'm renting something out, all right, normally this would be like I'm renting cars, hotels, I'm renting equipment, but this also relates to real property. So if I'm renting out property and the average use 7 days or less, so Airbnb, okay, then technically this activity that I have is not rental real estate. It's not rental activity and does not meet the threshold, and it's not passive income. It's actually non-passive income. All right. So it can get a little confusing, but you might have even heard, if you are really into real estate, the short-term rental like loophole. And this is really what it is. It's basically, I don't have to be a real estate professional, but I can still take my Airbnb short-term rental property losses against my non-passive income. But it has to be 7 days or less, okay? The second one is basically significant personal services. So this is for something that is over 7 days, but less than 30 days, okay? If you're also providing significant personal services, it's not rental activity. trade or business. Okay.
That's about serving you breakfast in the morning, right, Daniel? You're waking up.
This is the hotel rule. This is the hotel. Kyle, if Kyle's serving me breakfast, first of all, delicious. Never has happened in my life.
I'm a terrible cook.
Yes.
Just to be clear. Yeah.
And I'm paying him money, even if he's letting me stay at his house. That is trade or business income. Okay. So I called the hotel. It's called the hotel rule because all the normal hotel stuff. Are they providing upkeep daily, turnover, making the beds, doing the towels? Are they providing, breakfast? Are they providing concierge services? These kind of activities. So hotels, even if the average use is over 7 days. So if it's under 7 days, it doesn't matter. But if it's over 7 days, all right, this significant personal services come into play. Okay. So just keep that in mind, even if my average rental use is over 7 days, but under 30. Okay. So if it's over 30 days, then it has to be extraordinary personal services. All right. So it's a whole different definition, which basically means the rental activity is insignificant. This would be like a hospital. Like I go into the hospital, technically I'm renting a bed, right? But that's not why I'm in the hospital, right? I'm in the hospital because I'm sick. I have something going on that I need to be in the hospital. That's really the service I'm there for. The rental part of it is just, it's an insignificant portion of it. Okay. So that's 3 exceptions to the rules of any rental activity. Other little information I kind of wanted to go over is like how like-kind exchanges and passive activity losses rule. Okay. So if you do a like-kind exchange, what happens if I have a passive activity loss? All right. Well, if you have any sort of gain, all right, you can do a like-kind exchange and unfortunately still have some of the gain, all right, if there's foods involved. Well, my passive activity loss can, of course, be deductible up to the extent of any gain that I created from my like-kind exchange. But unfortunately, any excess will be carried forward to the replacement property. Okay, so that's something we need to make sure everyone understands. I do a like-kind exchange. I don't get to unlock this passive activity loss. All right. It just carries forward into the replacement property. That also means that doing a like-kind exchange might not always be the best tax decision because unlocking that passive activity loss might actually wipe away all your gain and more. So why are you doing a like-kind exchange? Okay. Something to think about there. All right. Last bit of thing I want to get into is cost segs. So the reason why there is all this discussion about taking rental losses is mostly because cost segs can make you accelerate basically taking depreciation. Okay, so it's called cost segregation. All right. Very normal real estate tax strategy. I buy a property, it depreciates over, let's say it was residential, 27.5 years, commercial, 39 years. All right. So I get a little bit of deduction over a long piece of time. Cost segregation lets me accelerate depreciation because really when I bought that building, it's actually personal property, 5 years, 7-year property, 15-year property, and 27.5 or 39-year property. Certain property that's lower, like 5, 7, 15, allows me to take bonus depreciation. So I get to accelerate bonus depreciation a lot. So now I'm depreciating 20 to 40% of the building year one. Okay. In that case, that is going to probably create a significant loss. Okay. If you're a real estate professional, you get to take all of it into all your other non-sources of income. But if you're not a real estate professional, okay, most likely what's going to happen unless you have significant other passive sources of income is it's going to get suspended and move forward. So make sure if you are doing cost segs on your rental properties, hey, do I meet real estate professional status? Can I actually take this down? Sure. Is it worth it? Because if it's not, then you're probably spending a lot of money up front for no tax benefit. Okay. So we want to make sure we understand these rules so that we can use it, because there's a lot of people out there just saying things that maybe are half right, half wrong. right, but not in a certain circumstance, or more specifically, not for your circumstance.
Yep.
Okay?
And Daniel, I don't know about you, but I get a lot of the hearing about transactions on the back end, right? So it's a lot easier. We've gone through 5 pitfalls, exceptions, et cetera. So it's a lot easier to deal with this, not the day before closing or something like that, right? So it's good to have these conversations as you go. Save you headaches at the final minute.
Absolutely. There's Kyle and I both have stories of people coming to us after the fact, talking about these specific examples and scenarios we're having, and then we have to be the bad people because they got bad information.
Listen, I'm just the messenger here, right?
Yeah.
Law's the law. I do what I can, but I'm just the messenger.
So it's important that if you're meeting real estate professional status, or even if you can't, but you want to invest in real estate, it's important that you are talking to a CPA, a professional who really understands the rules, who can consult you and make sure that you're taking full advantage of the tax code and you're not just doing stuff that you can't take advantage of and unfortunately costing you more money and headache than it should be. I think that's enough time we have today on passive activity losses. So thank you for staying with us for the entire series, and stay tuned for our next video. Take care.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.